In today's video, I'm going to show you 6 price action patterns you probably haven't seen before. I will explain how the patterns work and their basic trading strategies. Before we dive into these patterns, please keep in mind that you must always try to maintain a healthy risk-reward ratio in your trades, meaning that the potential profit must be a few times larger than the stop loss. The first price action pattern we're going to talk about is called bump and run reversal. The bullish version of the bump and run reversal looks like this. The bullish bump and run reversal pattern starts with 1 or 2 consecutive lower highs, which allow the trader to draw a downsloping trend line by connecting these highs. After that, the trader will be able to spot a significant drop in price in a movement that exhausts the energy of sellers. Price then comes back in the direction of the downsloping trend line and breaks it to the upside. Price will often retrace back to the downsloping trend line to test it as support. This is the window of opportunity to get in the market to the upside. Sometimes price will not come back to test the downsloping trend line. In this case, the trader can use this pattern as a signal to continue in a pre-existing long trade. To get in the trade, you must observe signs that price is indeed respecting the downsloping trend line as support after breaking it to the upside. You can look for things like reversal candlestick patterns when price tests the trend line in order to increase your chances of success in the trade. The bearish bump and run reversal pattern works in the exact same way, but everything is flipped upside down. It starts with 1 or 2 consecutive higher lows, which allow the trader to draw an upsloping trend line by connecting these lows. After that, the trader will be able to spot a significant rise in price in a movement that exhausts the energy of buyers. Price then comes back down in the direction of the upsloping trend line and breaks it to the downside. This is the window of opportunity to get in the market to the downside. Sometimes price will not come back to test the upsloping trend line as resistance. In this case, the trader can use this pattern as a signal to continue in a pre-existing short trade. To get in the trade, you must observe signs that price is indeed respecting the upsloping trend line as resistance. You can look for things like reversal candlestick patterns when price tests the trend line in order to increase your chances of success in the trade. The next pattern we are going to talk about is called cloud banks. This pattern begins with a lateral movement in price. After that, price produces a sharp decline and then comes back up to encounter the great resistance produced by the initial lateral movement. Notice that in the cloud banks, we can observe a V-bottom pattern. The advantage here is that once the V-bottom formation is spotted, the trader has a clear goal to where price can go, which is the cloud bank's resistance. The trader can also look to trade price action at the cloud banks, and there are a few possibilities. Price can either respect the cloud banks and start trading down again, it can enter the cloud bank and trade in a lateral movement, or it can break the resistance provided by the cloud banks and start trading upwards. In order to know which of the possibilities is more likely to occur, the trader must pay attention to signs that price is respecting the limits outlined by the cloud banks. Once again, the good thing about this pattern is that it provides a clear price range out of which price action will produce a significant movement. Next in line, we have a pattern called diving board, which is similar to the cloud banks in some ways, but it's geared toward a long trade. Initially, we have a small consolidation or lateral price movement. Then price drops in a sharp move, and then comes back up with even more strength, breaking the resistance provided by the initial lateral movement. Ideally, the trader should wait for price to retrace back to the horizontal line that comes out of the flat highs to enter a long trade. Don't forget that once price reaches that level, there must be signs that price is indeed respecting that level. This is probably the most important aspect of trading any sort of price action pattern or chart pattern. The trader must observe some type of reaction when price meets a support or resistance line in order to validate it and increase the chances of success in the trade. If you are enjoying the video so far, please help support the ongoing creation of free videos like this one by clicking the like button and subscribing to the channel. The next price action pattern we'll look at is called horn. The bullish variation is called horn bottom and the bearish variation is called horn top. This pattern can be seen as a fractal version of the double top or bottom. In the bullish version, called horn bottom, price action creates 2 spikes down that are separated by 1 candlestick only. The reason this is the fractal version of the double bottom is because if we looked at this in a lower time frame, we would see a normal double bottom formation. A long trade can be opened if price begins to rise after the second spike down. The fact that price hits the same support level twice and cannot get past it is evidence that the market will start rising right after it. In the bearish version called horn top, price action creates two spikes up that are separated by one candlestick only. The reason this is the fractal version of the double top is because if we looked at this in a lower time frame, we would see a normal double top pattern. In other words, the horn top and horn bottom patterns are like seeing a double top or double bottom from a distance. This allows the trader to have an impression of what's happening in a lower time frame without actually changing time frames. A short trade can be opened if price begins to fall after the second spike up. The fact that price hits the same resistance level twice and cannot get past it is evidence that the market will start falling right after it. The next pattern we are going to see is called pipe. The bullish version, called pipe bottom, is characterized by two adjacent and unusually large spikes down. This is similar to the horn pattern, but there is no candle in the middle of the spikes. This also implies a double bottom formation in a lower time frame, but it's as if we are zooming out even farther in relation to the horn formation. The two large lower shadows make it clear that there is buying pressure, so a long trade can be opened with a stop below the spikes and a target 3 times larger than the stop. The bearish version, called pipe top, is characterized by two adjacent and unusually large spikes up. This is similar to the horn pattern, but there is no candle in the middle of the spikes. This also implies a double top formation in a lower time frame, but it's like we are zooming out even farther in relation to the horn formation. The two large upper shadows make it clear that there is selling pressure, so a short trade can be opened with a stop above the spikes and a target 3 times larger than the stop. The final pattern we are going to talk about is called roof, and it's similar to a very famous pattern called head and shoulders, but there are extra details. The roof is characterized by successive higher highs followed by successive lower highs and flat lows across the whole pattern, forming a roof-like shape. This can either be a bullish or a bearish pattern depending on which direction price breaks out. The pivot in this case is the horizontal line determined by the flat lows. If price breaks out to the upside of the roof, the trader must wait for it to retrace back to the support line given by the flat lows, and then enter a long trade. If price breaks out to the downside of the roof, the trader must wait for price to retrace back to the resistance provided by the flat lows. The advantage of knowing these patterns is that you can develop an edge by seeing what most people are not seeing in the price chart. So these price action patterns tend to provide better profits in comparison to the patterns that almost everyone can see. That's it for this video. If you are interested in chart patterns or price action patterns, I have a free video course about many other patterns here in the channel. You can find a link for this course in the video description. This is one of the most watched videos about chart patterns in the world with over 4 million views, so it's worth checking it out. I also have a free course about candlestick patterns which you can use in alignment with price action patterns or chart patterns. This one is also one of the most watched videos in the world about this topic with over 5 million views. If you wish to learn how to trade, check out my premium courses available in the video description as well. If you like the material I create, please help support the channel by clicking the like button, subscribing to the channel, activating all notifications, leaving your feedback in the comment section, and sharing the video with your trading community. Thank you very much for watching, and I hope to see you in the next videos. Take care.